All right, let's finish up chapter 8. And so we just have probably 10 or 15 more minutes to finish this. So there's actually two different methods that we can use for the allowance method for coming up with that estimate for what we think will be bad debt. So one of them is called the income statement approach, and one of them is called the balance sheet approach. So when we're doing our estimate, this is the approach we're going to use because it's the easy approach. And all you do is you look at like net sales and you do a percentage. So 3% or 5% of credit sales. So down here, the other way to do it is to actually like dig deep into accounts receivable. And what you do is called an aging. So you say, how old is the accounts receivable? Because obviously a customer that's 6 months past due is a lot less likely to pay you than one that's current. And so you look at different categories of how old the accounts receivable is, and you come up with different percentages for different people. And then you compute a desired balance and allowance, and you adjust it to get there. And we don't cover this method until intermediate accounting for my accounting majors, but we just covered this one in financials. So just a percentage of credit sales. So again, like when you have a customer that has previously been written off, you do 2 entries. There is a different method. Instead of the allowance method, there's a method called the direct write-off method, but we aren't going to cover that method either because it's not GAAP. With the direct write-off method, you do not do an allowance account at all. And when you find a customer that's bad debt, you just put it in bad debt expense. And so very straightforward, very simple, but it's not the method we use for GAAP purposes for financial accounting. We do use it for taxes though. So we have to convert everything to that for taxes. So, okay, so let's go ahead and let's do another set of transactions similar to the ones we did on page 2. All right, so provided services on account. And so normally I just let the students do these on their own and then I just check them. So if you want to hit pause and just do them all and then watch me, that's fine. So if you want to pause and try these transactions by yourself, that's fine. So provided services on account. Accounts receivable and revenue. Collected some money. And then estimated, look, uncollectible account expense. That's just another phrase for bad debt expense, uncollectible account expense. So I'm just going to call it bad debt expense. That's what I like to call it. So we do this at the end of the year. And we look at a percentage of credit sales. So the journal entry is always a debit to bad debt expense and a credit to allowance. And it says 1.5% of credit sales. So credit sales are sales on account. So if we had cash sales, we wouldn't do the percentage of cash sales because we don't have to worry about collecting those, but we are doing them as a percentage of credit sales. So 4,000 times 1.5%. So there's a couple different ways to do that. 1% is 40, and then half of that, so 1.5 would be 60. But all you do is 4,000 times 0.015. That's how you do 1.5% in your calculator. I think you know that, but just in case. So $60. Again, I did 4,000 times 0.015. Okay. All right, next year rolls around and we are going to write off a customer. So when we write off a customer, we remove it from allowance. We knew this was going to happen. We put $60 in there. Now $40 is being written off and we remove them as a customer. Okay, so that's $40. Provide services on account and collect cash will be just like transactions above. Oh no, what's that? There we go. Okay, so sales on account 6,500, collections 5,400. Received $5 from a bad debt that has been previously written off. Reinstate the account and then record the $5 coming in. So here are those 2 transactions that go with that. So first thing we're going to do is reestablish them as a customer. When we do that, we do an unwrite-off. So this is a write-off. So we are unwriting off the customer. So put it back in accounts receivable, back in allowance, 445. These numbers had 3 zeros on all of them, and I just tried to make it easier. And then from there, we are going to go ahead and show us receiving the money. Cash and accounts receivable. So if we're already at year end for 2023, we had a pretty good year. We thought there was going to be $60 of bad debt. We wrote off 40, but then we wrote off 5 of it, so it didn't end up that bad. So the next year when we do our estimate, we're only going to do 1% of credit sales. So instead of 1.5%, we're just doing 1. So credit sales are sales on account. So that's what credit sales are. So I'm going to take 6,500 times 1%, which looks like $65. So, and then I'll do the exact same entry as this one with different numbers. So it was 6,500 times 0.01, which was 65 and 65. Okay. So the next question just wants to know what is net accounts receivable. And so just to practice that idea of net accounts receivable, which is also called net realizable value. So what we do is we would draw the T accounts. And so I don't have anywhere I can really draw T accounts right now. So where I'm going to put these. So for the first one, though, I think it's pretty easy because we have accounts receivable, and that's all we had. So it looks like accounts receivable is 1,000 and allowance is 60. So it looks like 940. And the next year we would need to draw the T's. I wish I had somewhere to draw T's. So I'm just going to go out in Excel and do that. So let me draw some T accounts for you. So accounts receivable had 1,000 in it from last year and allowance had 60 in it. And then what I need to do is I need to post my transactions into there. Take this, shrink it up. Okay. So I'm going to start with the first transaction, and it was a debit to allowance and a credit to accounts receivable. And then transaction 2 put 6,500 in accounts receivable. Transaction 3 removed 5,400 from accounts receivable. Then transaction 4 put 5 back in accounts receivable as a debit, and it credited here by 5. Okay, and then transaction 6. No. No.
Why?
Oh, actually,
Can you towards just go pick her up real quick?
is that okay with you? Okay, whatever. Okay, so I'm gonna. Oh wait, this is allowance. So I debited accounts receivable and I'm crediting accounts receivable, and then I am crediting allowance for 65. Okay, so sorry, this should not have been as hard as it was, but I'm just trying to post.
You say?
She is around.
Okay, so I have debits to accounts receivable here and credits here. I'm just trying to find my balance in accounts receivable. I know it's a debit because it's an asset. So I got 2060 for accounts receivable. Oops. And then over here, all right, I have a lot over there and reduced it by 40. That was my only write-off. I have 90 over here. So my net accounts receivable is 2060 minus 90. All that for that one little line right there. 2060 minus 90, which is what? Oh, 1970. Okay. So that is the net accounts receivable for the second year. So I like to go through that and do that manually, just so you guys can see me do all the posting and figuring out those balances. So the last topic in this chapter is notes receivable. So notes receivable is when we are going to charge our customers interest or charge our whoever we're loaning money to. So we can loan money to anybody we want as a business. And so maybe it's a neighbor that's starting a new business and we just want to invest in them. And so we loan them money, but we make them sign a note. We make them sign an agreement that they are going to pay us back. Just like when we borrowed money in chapter 2 from the bank and we said notes payable, same idea, but now it's receivable. So what we're going to do is we're going to use I equals PRT and we're going to calculate interest. And we did that in chapter 4. So you're comfortable with the formula, but the most important part is that our T is always annual. Our T is always annual because our rate is an APR, annual percentage rate. Our time has to be annual too. So on April 1st, 2022, Vandelay loans a $10,000 note to a customer opening a new store. The note, which bears 10% interest, becomes due on March 31 of 2023. Prepare the entry. So we are loaning money to somebody. We're going to give them cash, and we are hopefully going to receive it back in the future. Then on December 31, we are not going to receive any money because we're not getting our $10,000 back until March 31, but we have earned interest. We have earned interest. This is interest we are going to receive in the future. So we did this entry in chapter 4, interest receivable, interest revenue. So the R ones go together. We are going to receive interest. We like receiving. It is revenue. I equals PRT. So to calculate that number, I equals, and so we loaned $10,000 at a rate of 10%. And then I need to know how many months occurred between April 1 and December 31. April, May, June, July, August, September, October, November, December. Use your fingers. They're reliable. Always put 12 downstairs. It doesn't matter if this is a 7-month note, a 6-month note, an 18-month note. We always put 12 downstairs. Okay. So 10,000 times 0.1 times 9 divided by 12, $750. Okay, so we do this entry on 12/31, and that way we can do our financial statements for the year, and we can show that this is money we're going to be receiving in the future along with this. Those are assets. This would show up on the income statement as money we earned, even though we don't have it yet, but we have earned it and it's coming. So on March 31, we get all of our interest and our principal for the note. So we are going to get a whole pile of cash, and then we're going to have 3 credits. The first thing I definitely want is the principal. I want my money back. So I was planning on receiving 10,000, so that money came back. The next credit is the interest I was waiting on. This is last year's interest. So that is this $750. So this $750, I am now receiving it. This $10,000, I am now receiving it. But one other number that I am receiving is this year's interest. The interest that has happened in the current year. So to get that number, I equals PRT. So we'll do 10,000 times 0.10 times however many months happened this current year, January, February, March, 3 out of 12. Now this happened to be a 1-year loan, so that worked out great. But in your notes, if it was a 7-year loan, you just need to make sure that your numerators total 7. So this is a 12-month loan, so our numerators total 12. But if this was a 7-month loan, maybe 4 of them happen up here and the other 3 down here, or however it works out. So let's do the calculation. 10,000 times 0.1 times 3 divided by 12, $250. So it looks like in total, the cash received should be the total of those 3, which looks like 11,000. All right, so you're going to have 3 of these for homework. So if I go over here real quick and just show you. This is 8 homework. Yeah. So on tab 2, you're going to do 3 of these, and they are exactly like what we just did. So notes receivable cash, and then you do interest receivable and revenue. And I even made a little hint that says I equals PRT 20,000 at 7%. And then down here, you will show the money coming in and 3 credits. I did this one for you. This is the only one that you're converting an accounts receivable to a notes receivable. And so I went ahead and made a note there, but I did that for you. And then you'll do the other 2 entries. And then down here, you'll do all 3. And it's like the normal one. So it'll be the same. This entry will be the same as this one up here with just a different principal. Look, it says loaned $50,000 to a cashier of the company. How do we do that? That's a terrible idea. There is a little bit more information in the notes, but it's just about receivables turnover and how long it takes you to get your money from customers. And so if your terms are 210 and 30, you should be collecting all of your receivables about every 30 days. And so you can go ahead and calculate that and see how long it takes to collect your receivables. And so, okay, that's it for chapter 8. I hope you guys are doing well. Thank you.